Fed's next move, and what to expect for the rest of the year in gold, treasury, equities, and the US dollar. To discuss all of this, today my guest is founder and president, Forest for the Trees, Luke Gromen. Today's podcast is sponsored by TradeStation and FTSE Russell. Currently, TradeStation is running a promo just for our audience. New users will get 50% off brokerage fees for the lifetime of their account using the promo code FUTRAFZT. Go to tradestation.com/Anthony to learn more. Are you watching the stock market, specifically the Russell 2000? The Russell 2000 is a key benchmark for small cap US stocks. Be sure to check out the E-Mini Russell 2000 future symbol RTY and Micro E-Mini Russell 2000 future symbol M2K. To learn more about FTSE Russell and their products, please visit FTSERussell.com. All right, let's bring my friend Luke. Luke, how you doing, man?
I'm doing great, Anthony. How are you today?
I'm doing great. I'm so glad that I have you here today, back on the podcast. It's been a while, and obviously lots happened since you and I talked. It's been quite a while since we've talked, but I'm always following your stuff, and I want to get right into it today because this morning I see so many people talking about this is the most important CPI of our lifetimes, right? You know, it's so funny. Look, you and I have been doing this a long time. We always see these things are saying this is the most important number. This is really the end of the road here for X. What did you think about that? And what are your thoughts on today's CPI number?
Yeah, I laugh because it is. There's always seems to be the sort of most important number of all time, but I think this one actually lived up to the hype, or in terms of it being the most important number in a long time, certainly, if not in our lifetimes. And the reason I think it was so important is, had it continued to come in hot, then I think, given where we are on some technical levels in the indices, there is some indecision about, is this a bear market rally, or is this the beginning of a new bull market? Are we overbought in a bear market, or are we overbought in a bull market? And that's a really important distinction. And ultimately, had that number come in hot and forced the Fed to get more aggressive, still, I think that would have probably been a really bad day in the markets and forced positions to change. On the flip side, I think the number we got allowed this to, at least for the moment, continue to support the view that this is a bull market, that overbought in a bull market might be a good thing, and the Fed, we can start to discount perhaps the worst case scenario in terms of how much more draconian the Fed would need to get to fight inflation.
So let's just talk about inflation, right? I've actually put a poll out here. All of you watching, you could see that in the chat, and I encourage you to vote just because I'm curious to see what everybody thinks here. And right now, it's really a little bit heavier on the side of, has inflation peaked? A little bit more people say yes, but it's kind of split. What do you think about that?
I think inflation hit a local peak last month, and we've been saying that for the last several weeks, at least. With that said, I think, as you and I were talking about before we went on air, I think if it's important for investors to attach a time frame to that poll effectively. And what I mean by that is, in the short run, I think inflation has peaked. If we look out 12 to 18 months, no, I do not think inflation has peaked. I think sometime after the election, sometime in 2023, I think what is likely to transpire from here will drive inflation back probably into the double-digit range sometime in 2023, just out of necessity of the U.S. fiscal position. It's a real paradox. Is the Fed needs to fight inflation, but inflation is also the Fed's best friend, given the the debt and fiscal situation of the U.S. government.
So you see it coming back in double digits. Yeah. So of course I agree with you. It's the time frame. You know, when you look at everything right now, has inflation peaked in the short term? I think really most everybody kind of felt that way after that last CPI number. When this came in today, I think, obviously it confirmed it. And that's the ebbs and flows of things, right? And this is why I love talking to you, because you have a much longer term horizon than myself and probably many of the traders listening to this. What happens, I guess, from here? Because obviously we have to go from where we are right now. It's the path to getting to that double digit, I think, is obviously how does a trader or investor execute to that point? Because right now we do think, many people think that inflation has peaked. So what are we looking at from the Fed? Let's maybe go what's their next move to handle the fact that inflation has peaked, and what they do from here to eventually get to where you're saying it goes to double digits.
Yeah, I think that the next 3, 4 weeks, or however long we have until the Jackson Hole meeting where Powell speaks again, I think is going to be really critical for traders and investors to watch. Because if I'm right that the economic data on balance is going to get significantly weaker, the earnings data will be disappointing on net, then I think he will have the data in hand as he takes the podium in Jackson Hole to get more forceful with his data dependent stance. He didn't say data dependent, he said it depends on the data
Yeah.
2 weeks ago. And so I was asked last week or the week prior, do you think the Fed pivoted? And I said, I don't know that they pivoted, but I think they teed up a potential pivot in with how Powell spoke at that press conference 2 weeks ago. And so to me, I think it's all about the data for the next 3 weeks. I think the data is going to get a lot weaker over the next 3 weeks on net. The jobs report last week, notwithstanding, which is still a bit of a head scratching outlier for me. And then we go into that Jackson Hole, and I think, particularly if you get enough weak data over the next 2, 3 weeks, I think there's going to be, like you said, a build of expectations of, all right, there's no way he's going to be able to say we're going to do another 50 or 75. He's going to have to get a little bit more dovish still, and I think that will add fuel to this rally that they are done for now. That then gets you into September. I think part of everything we're seeing is just trying to limp this thing into the election. And then they've got the policymakers, broadly speaking, both monetary and fiscal, have 12 to 18 months to play with where they can get some things done before they have to start sort of worrying about getting reelected or elected.
I agree with you with they're going to really kind of limp their way into the election. I really do see that happening. Unfortunately, they're not supposed to be a political organization, right? But it's just the way it is. But I look at it like this too, and I say, why do they have to get more dovish? I know that you think that the economic data will come out weaker, and I think I understand that, right? But don't they, I don't want to say mandate, but didn't they say they're going to get to like 2%, right? I mean, and we're just so far away from that. I mean, do we really see them? I guess that's where I keep in my own pivoting, where I'm like, are they really just going to just totally get away from that?
It's interesting, right? Because we've got a country with an emerging market debt to GDP, an emerging market deficit to GDP, an emerging market wealth inequality, emerging market deindustrialization, emerging market income inequality, emerging market child mortality, emerging market drug overdose problem. Another 100,000 people died last year, reminiscent of Russia in the 90s. We got all these emerging market factors, and overwhelming consensus is that we're going to run a developed market monetary policy over top of this. And I, I just think that we're in a situation where traders are assigning a 0% chance or close to a 0% chance of the Fed running an emerging market policy when you total up these factors I just described, particularly the balance sheet and the fiscal position, they would tell you that it's a near certainty that the Fed is going to have to run an emerging market policy. And so, yeah, as a trader, as an investor, you get these situations where the consensus is giving you a near 0% chance, and history and math are giving you a near 100% chance. These situations, they don't come around very much, but they're very, very interesting. And so to me, I think I am trying to figure out how to phrase this. I am surprised and interested how little time is still being spent around the inflation discussion as it relates to the U.S. fiscal position. And in particular, what I mean by that is part of the reason they had to do this fiscal stimulus that was too much, the part of the reason they had to inflate was the US's true interest expense, which I look at entitlements and the pay-as-you-go portion of entitlements and Treasury spending. That number was still over 100% of tax receipts for most of 2021. It only touched back below 100% of tax receipts earlier this year. And tax receipts have been very good year to date. They're slowing, flattening, rolling over now with the slowing in the economy and the rolling over of asset markets. But as a couple different investing graybeards told me 4 or 5 years ago, is that the fiscal position for any country is never a problem until they have to print the money to cover the interest. And if you define interest in the United States, not just as the true nominal interest, that Treasury spending number, but as the effective interest, which is what you owe on your off-balance sheet obligations just to keep those nominally money good, which is entitlements. And people don't realize this. That number is running at a $2.9 trillion annual rate right now. That is $2.9 trillion a year. U.S. tax receipts are at all-time highs going back at least 40 years, and they're 4.4 trillion, 4.5 trillion. So you're talking about effective interest just on the entitlement side is about 60% of tax receipts, and tax receipts are at all-time highs. Inflated, the tax receipt looks like a bubble, just like the asset markets, just on a lag. The receipts haven't rolled over with asset markets yet. They're going to. They're starting that process now. So then when you add Treasury on top of it, Treasury spending all in is another $1 trillion. Some of that is some stimulus that's rolling off, but some of that is going to be met with higher interest expense, since roughly a third of your Treasury is outstanding, reprice within 12 months. And obviously what we've seen in short-term rates, interest expense is going to go up a lot when those reprice. So you're looking at a situation where they barely got their interest expense below tax receipts, and now tax receipts are going to roll over. And so these are things that we as Americans, as Westerners, have not had to think about for a very long time in the United States, really since, I wouldn't even say the 70s. Since the aftermath of World War II. And so no one's thinking about it, yet it's an issue. And so that's ultimately what I think the governor on what the Fed, can the Fed get back down to 2? Maybe. But if the Fed getting back down to 2 requires a recession's going to knock tax receipts comfortably back below this true interest expense. And now you're into this weird time where the U.S. government's going to be crowding out Treasury markets. U.S. is going to be in a recession, but short-term dollar rates are going to be rising. Treasury yields will start rising simply because you're going to be crowding out global dollar markets. So this is a dynamic I still think is wildly underappreciated and basically all but ignored in the whole inflation discussion that I don't think should be ignored.
I don't hear very many people. I hear almost no one talking about it. And I think that's when I think of what the Fed is looking at and focusing on. So I'm just trying to wrap my head around everything that you just said, right? Because part of me thinks that it's the pivot is coming because their focus is going to shift. So it's not going to be that they're going to go from, well, inflation is the focus to a different focus. I guess essentially is that what you're saying?
Yeah, I think that's what we've been watching, right? Is been central banking has become about narratives. Governance has become about narratives. And so if you can just change the narrative in people's mind, right? Hey, don't worry about that CPI is from 9 down to 6, and now we're pivoting. It's not that we're pivoting at 6 like an emerging market. Hey, gasoline's $3.50. Ooh, gasoline. President Biden. Now, never mind that he is doing something that is entirely unsustainable to get it from $4.50 down to $3.50. Most Americans don't care. They won't look. The news won't ask. And so I think it's all about changing that pivot. The Fed has gotten oil down, or changing that narrative for the pivot. Yes. The Fed has gotten oil down. The Fed has seen the peak in inflation, and it's going to keep trending lower. You can redefine whatever the narrative is, but I think we will start to see that redefinition of the narrative in coming weeks. And I think, quite frankly, like I said, the data is going to help. I think the data is going to get a lot weaker. To me, it's not that the data is not going to get weaker, that inflation is not going to come down. I don't think it's going back to 2. I think they're going to have to pivot with CPI, headline CPI, still running at a multiple, whether that's 2x or 3x of their 2% target. And I think the reason they're going to have to pivot is this emerging market balance sheet and fiscal position that they're in.
It is a lot to take in. And, you know, I've got you here. And I mean, I'm actually kind of just even tired of this question. I know you said that you think that we're going to be into a recession. Just answer a couple things for me, right? Make me smarter, Luke. Are we in a recession? What is the definition of a recession?
Perfect example of what I just said about with the narrative, right?
Exactly right. Yeah.
We're gonna redefine what a recession is. We're gonna take and cross out the Webster's definition of 2 quarters of declining real GDP because it's politically inconvenient, and that's fine. Like, this isn't busted on the Biden administration. I don't really care who's in power. This is the kind of stuff that's happened when governments get into bad positions, regardless of whether you're an EM or a DM or whether you're, wherever you are in history. You go back to the 30s and, the FDR administration and the Hoover administration were making up numbers to make things look better than they were. This is politics. So are we in a recession? Yeah, I think we're in a recession. And the most important thing for me is, again, we're starting to see a recession in tax receipts, particularly among the things you would consider a leading indicator. New York City estimated tax payments in June down 31% year over year. California tax receipts down 20% year over year in June. We always hear, hey, New York and California, they're leading indicator. Here we are. And it makes sense. These are the U.S. economy has effectively the marginal driver to consumption in the U.S. economy, which has historically been consumption driven, has become asset price driven. You can see it. You run tax receipts year over year in the federal tax receipts year over year against U.S. asset prices year over year. Just use the S&P 500. And you can see clear as day, really, since the mid 90s, increasingly, the stock market leads tax receipts up and down. And the stock market is now down, whatever it is, 15, 20% year over year. Those comps are actually going to get tougher for the next several months. Tax receipts are going to go down. And if tax receipts are down, whether or not the politicians say we're in a recession technically or not, the number that matters most to them, the numbers that matters most to the Fed is yes, tax receipts will be down. We will be in a recession. They will have to react.
Is this 87,000 new IRS agents conveniently timed here?
Oh man, you're gonna. I don't know.
Because everything you're saying to me really goes back to this. I mean, it's not something I even thought about asking in this interview at all. But it's obviously, I mean, you're talking about what's really happening right now. I mean, this is, tax receipts is an issue.
Tax receipts is an issue. Maybe they think hiring 87,000 more people. A, it will help the jobs picture. B, it in theory will help the revenue picture. I question whether it will, because when you look back through history, I forget whose rule of thumb it is. Maybe it's Art Laffer's, but the bottom line is that no matter what your marginal tax rate is, you rarely get more than 20% of GDP in tax receipts. And so, it's not like we're running massively below that now. When you look at this wealth and income inequality, so much it's so extreme that basically, for example, 5% of taxpayers pay 60% of individual U.S. income taxes, 30% of overall income taxes. These are people who are in large part likely not making their money on an hourly cash wage basis. They're likely very tied to the stock markets, et cetera. So you get rid of the carried interest loophole, but you hire 87,000 more IRS agents. Like, what are you going to do? How are you going to get more money from, the ultra wealthy that benefit from this carried interest loophole? You're not. So I don't know. It's a political question. That's why I'm kind of wavering a bit. I don't know if it'll matter or not. I do think you're going to have a hard time getting a lot more than what you're getting, but we'll see.
I hear you. Yeah, I mean, we're not here to talk politics anyway. Right. You and I are here to talk about markets. But when you mention something like that, it just to me is like, okay. I mean, obviously, everyone's seeing that this is an issue, right? That we have tax receipts as an issue, and it's something to keep an eye on. I mean, that's the bottom line. I mean, to me, that's right. As a trader or an investor, I have to know, what.
It's a great signal, right? Yeah, it's like, hey, they're hiring all these guys for some reason. Why not 5 years ago, 10 years ago, 20 years ago. It's not like the
Exactly.
issue
That's
didn't
my
exist.
point.
That's a great point. Yeah,
So I
very
want to
good.
go to let's go to Twitter here, and also everybody along the way, if you guys have any questions or comments, please put them in the chat. We love to hear from you, and I will definitely put those questions on to Luke. You put this tweet out. You quoted Jared Dillon. He said the dollar has topped, and I'm just going to read the tweet
Sure.
for everyone listening on audio later. It says, "Curious fact pattern. Dollar peaked July, I should say DXY peaked July 14th. On July 15th to the 16th, G20 finance ministers and central bank governors met. Meeting was overshadowed by Biden's visit to Saudi. Was there a temporary Bali Accord to weaken the US dollar? Remember the rumored February 16th Shanghai Accord? Let's watch." Talk to us about this. Why tweet that? Explain this to
Yeah,
me.
it's I've just been watching over the last, I guess it's almost month now, and it was something, I'm pretty knee deep in a lot of this macro stuff and the dollar, of course, et cetera. And the dollar's a key linchpin to pretty much everything macro. And I didn't even notice it. I had not even heard that this G20 finance ministers and central bank governors meeting had happened. And it wasn't like it was some sort of top secret thing. It was so overshadowed by Biden's visit to Saudi and oil and all of that, and the Russia situation, et cetera. It just really didn't make even the financial news waves, let alone or news wires, let alone the mainstream news wires. And so I had one of my best relationships on Wall Street reached out and shortly thereafter said, "Hey, did you know this meeting took place?" And I said, "I had no idea." And it was a really good thought process on his part, just saying, I wonder, is it possible they discussed the dollar? Because these types of things, if you go back to February 2016, there was something that was never confirmed. It was the same G20 finance ministers and central bank governors that met in Shanghai this year. This year they met in Bali, and they come out with all this word salad press releases and whatever. And then you just watch markets and the dollar weakened. And if you remember February 16th, 2016, things were pretty iffy. You were, US shale was really imploding, so on and so forth. Markets were under pressure. Dollar weakens, markets find their footing, and sort of away we go. And it was a little bit similar this time where you have this dollar spike into it. You've got markets really under pressure. And then all of a sudden, the further away we get from this, dollar comes down, markets start, they'd already found their footing. I think they officially bottomed, I think June 24th, something like that, right? So this is a couple weeks after that, 3 weeks after that. But since then, obviously, the markets, NASDAQ in particular, had a really good rest of July into August. And so it just was more, who knows what was agreed to, what was not. You read the word salad press release this time from them or communique from them, and it's committing to financial stability and committing to coordinated action with each other and, blah, 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 some of that. But, financial stability and a spiking dollar, you can't, you can only have one of those two. And then when they start talking about coordinated movement and stuff, it just makes you wonder. And so it's really interesting as we get further away from this with the benefit of hindsight, you're seeing a lot of things that, like, okay, July 14th, dollar peaks. It's now down, I don't know, from almost 110 to 105. So that's a pretty substantial move in less than a month's time in the world's reserve, in any currency, let
Yeah.
alone the world's reserve currency. Euros up off critical levels, moving them maybe a little bit away from a currency crisis. Yen, same thing, buys them some time. Oh, by the way, stronger yen, stronger euro will, all else equal, help improve European and Japanese demand for treasuries, which not too far before July 14th, we're seeing significantly rising yields as the U.S. economy and markets deteriorated. That is a big no-no. That's an Achilles heel for the entire U.S. and global financial system. Crypto starts acting very, very well post-July 14th. Side note, Biden meets with MBS that day. Oil's down 12, 14% since July 15th, 16th. So you've got this sort of, maybe it's completely nothing. Maybe there was some sort of coordinated activity. It's one of these things where give us another 2, 3, 4 months. I think we'll know.
Yeah.
But the interesting thing to me is just nobody's talking about it. Nobody.
Nobody. I haven't heard
And
anyone.
and so it's something I've been watching, something I've been writing about for clients for the past 2, 3 weeks. And so it was, just kind of highlighting. When I saw Jared's tweet, and Jared's great, super thoughtful. I just wanted to add on top of that. I was like, hey, because he's watching, he may be watching different factors than me, and it just spurred that in my mind, which was
Yeah.
what drove the tweet.
Let's talk about interest rates a little bit. I mean, look at the yield curves. I mean, there's so many things that point to saying that we're in a recession, right? And I mean, you got the 2-year today is coming in at basically 3.18. You got the 10s at 2.7. I mean, the 30 is 3.05 and the 5s are 2.89. What are the yield curves telling us?
Yeah, yield curve's telling you we're in a recession. I think people are looking at the 2-10, and I think purists say, well, we should really be looking at the 3-month 10, and
Yeah, exactly. I've heard that.
really, I'm sympathetic to that view, quite honestly, because I can see why. But in the end, for me, I think where I come down on it is the 2-10 is sort of, it's like the Pareto principle, right? It's like the 80-20 rule, or it's probably more like the 90-10 or the 95-5 rule, which is, in our business, you get something, 60-40, you should be probably making, you get 60-40 odds in your favor in this business. You should probably be, looking to do something about it. You get 90-10 or 95-5 odds in this business, they don't come around much. So that, the 2-10 is telling you, I think that we're in one effectively. And I think that's right.
Yeah, I mean, I hear a lot of people say that also whether it's the euro dollar or what interest rates are telling us about the Fed pivot, and maybe you can quickly explain what a lot of these people are seeing and saying, is that the interest rates are telling us that the Fed is going to pivot. There is something bad coming at the end of the year. How do they see that? Why are they seeing that through the interest rates? What's telling them that?
Yeah, just this basically. I mean, when you talk about a curve inversion, there's a bid all of a sudden over the last 8 weeks at the long end of the curve. I mean, you go back to, probably second, third week of June. The 10-year was breaking out. If I remember it, yeah, right around, yeah. So
Yeah.
yeah, second, third week of June, 10-year's breaking out with the economy, with inflation. And then, basically, what the market's telling you is that people are saying the Fed is going to break that move in 10-year yields. I think you're seeing money out of equity markets into long end of the Treasury curve on the belief that the Fed is going to be willing and able to put the market or put the economy into recession to stave off inflation the way Volcker did.
It's interesting, and I don't know history when it comes to this stuff, but has there ever been a time where you've had an interest rate environment like this, right? Where you've had interest rates going up as they are, and you've seen this happen, on the 2s, 5s, 10s, and 30s? I mean,
Yeah, there was Harley Bassman, who's forgotten more about rates than I'll ever know, had a great piece. This is probably back in like February or March of this year, where he pointed out that, yeah, you were seeing the curve flattening away prior to really the Fed even doing anything that had never occurred going back 40, 50 years, which it was really interesting at the time. And to me, it speaks to a catchphrase I've been repeating over and over, which is the Fed's trying to ride two horses with one ass, from the movie, from the rom-com Sweet Home Alabama, right? Which is, or that they're operating a switch, not a dial. And it's really just a concept of leverage, which is when you get sovereign debt as high as it is, you don't have the luxury of turning inflation down a little and turning unemployment up a little, and that slows things, and then we can do the soft landing. It's leverage is leverage. Leverage means a little move, wham, like economy off, economy on, economy off. And I think that ultimately is the message of what we've seen in what the yield curve has done year to date, has been the bond market going, listen, the Fed, the Fed's, oops, sorry, I hit my table here. It's not an earthquake in Cleveland. The Fed, the bond market went, the long end of the bond market went from the Fed is not doing enough to fight inflation to the Fed just turned off the economy. The Fed just pulled the plug out of the wall. So that's the challenge of the environment where they're trying to ride two horses, one ass. So they need to inflate to get the debt position sustainable. By the same point, the unsustainable debt position makes it much harder to sort of get that setting right. It's really just flipping a switch on and off.
Man, I tell you what, you opened my eyes to definitely a couple of things already so far in this interview. My brain is working OT. I got to worry about getting too much gray here, Luke. It's a fear of mine. No, but everybody, we're going to start taking your questions next. I see you put some questions in chat. I have some questions from Twitter. We're back in 15 seconds. We're going to take your questions. All right, we are back, everybody. So I actually want to go to gold next because somebody actually sent a question on Twitter, and we'll go to that here in a second. So let's go back to this. All right, so Lord Richard Head on Twitter at Dennis Brain. I've heard that gold has an 8-year cycle. Do you think it's true? If it is, where are we now in that cycle?
8-year cycle. Let me think about it real quick on the fly here.
Let's pull up a gold chart in the near term. I don't know where he's getting that from. I was just curious. I don't know if he knew you or followed some of the stuff you were talking about.
Yeah, no, I've never talked about that, but I'm just thinking, okay, say 03 to 11 and then 11 to 19, there's been sort of an 8-year up, 8-year down if you want to talk about it in those terms.
Let's go to the weekly here.
I don't know from a longer term perspective if that's the case, but beyond
you look at from this high, so 11 to really 19, that high was in. So that's 8 years.
So, 8 years, yeah.
So now we're in this maybe where it's going to take that long to make a new high again. So that would be from 19, so 27. I don't know. My body can't hold it until next month, let alone holding long till 2027.
So I guess to answer the question, I don't know about the 8 years. I've not heard that before. That's not to say I don't have a comment on it because I've not studied it enough to have an informed opinion. With that said, I think gold is being held back by a view that Powell's choice is Arthur Burns or Paul Volcker, and he's going to be Volcker. And when you go back to our prior part of our discussion about the fiscal situation means Volcker is not really an option. His options are Arthur Burns, in other words, high inflation, or Benjamin Strong, the Fed chair right before the Great Depression, who over-tightened and sent the world into the Great Depression, the United States included. Those are his choices, Burns or Strong. And to me, there's gold doing what it is doing. I think there's still the belief that the Fed can be Paul Volcker, that Powell can be Paul Volcker. The history of countries with the United States fiscal and debt position over the last 200 years would tell you there's a virtually 0% chance of that happening. But who knows, right? Maybe the Browns will win a Super Bowl someday. You never know.
If they ever got a quarterback, maybe. They're like the Bears.
Yeah. But I think we are so as it relates to gold, if I'm right and we're in the early stages of a pivot necessitated by the fiscal position, regardless of where headline CPI is, then I think gold's going to have a really good couple of years and potentially a really good couple of months as perception goes from Powell is Volcker, watch him take inflation back to 2 to Powell is not Volcker. He's pivoting with CPI at 5 or 6. And I think that's probably really good for gold for at least several months. And I think you probably get to new highs on that. So let's see. But
Yeah.
that's how I'm thinking about gold.
Let's go to silver because I always go back and forth with silver. I listen to some great people. I've had Tavi Costa on the show a bunch of times, and I asked this question to Tavi, and I said to him, I said, "You think that things are going to continue to get weaker, but yet you talk about silver being an important, um, obviously, tool for machines. It's used in so many different things, right? It's a little different than gold in that respect, right? So silver there's a use case for it. So if you see that things are declining." How do you make a case for silver? Because I don't think you compare it the same way as gold. And, he is always great at answering that question. But I guess I have that same question for you, or just what are your thoughts on silver in general?
For me, silver has, like you said, the monetary element and the industrial element.
Yes.
From the industrial side, it's fascinating to me. I hear all of this talk about ESG and energy, low emissions and carbon neutral and climate change. And this is oversimplifying it, but my understanding is that those initiatives have like 0% chance of being successful without using a whole heck of a lot of silver.
Yeah.
And if that's the case, then it seems like they have virtually no chance of being executed upon with silver prices anywhere near here. And so I agree with your thought process in terms of, hey, if the economy is weakening, as I think it is, industrial demand side for silver, it gets hurt. The fiscal monetary side probably gets a bid for silver. How those two things net out, I don't know.
Exactly.
In the short run, but from a intermediate to long term perspective, to me, like if this ESG and EV and all of these sort of non fossil fuel, non carbon stuff is going to happen, I don't think silver has the right digit in front of it, and it might need a zero at the end of it too, an extra zero at the end of it too, by the time that cycle is said and done, if they're actually going to achieve those aims. But it's not something I've done a lot of detailed work on. It's just more intuitive.
Yeah, that's why I always look at it as like it's a push and pull market. I mean, I just don't see. I don't, and I'm not a macro person, but it's hard for me to follow the case that people think silver is going to do extremely well, as an investment. When most of the people that say that think that we're going to decline, and I look at it and go, well, you don't have that full participation behind it. So I think that's why I think gold would do better if in that type of thinking. I want to go to this question actually. RRSP is asking, how will the 95 billion MBS sales starting in September affect 30-year rates in housing? I'll just go, while I'm at the charts, I'll go back to 30-year. So just curious what your thoughts are on that, Luke.
Yeah, I think it's I think it in a vacuum, I think it sends housing, or I think it sends mortgage rates up. I think it sends treasury yields up at the long end, and it slows the economy further, since the 10-year yield is in a lot of ways the policy rate of the real economy of the United States. It ties back into my point before about this fiscal situation and the importance of tax receipts. Because when you think about it, let's take a step back, right? So we just had Treasury come out last week, I think on Monday, come out and say, oops, we thought we were going to issue 166 billion in treasuries in the third quarter, and it's actually going to be 444 billion. So it was like an extra $282 billion in a quarter issuance between friends, right? That's not that much money. So then maybe it was a 206. I think it's actually 262 billion. I think it was 182 to 444, something like that. Okay, so and they said part of the reason for the slowdown is issuance, or excuse me, for tax receipts. Tax receipts are coming in a little soft. Okay, so the U.S. government right now is running, call it $1 trillion to deficit prior to that year to date, right, on an annualized basis. So they need to find buyers for $1.2 trillion in treasuries. Now they just upped it at $1 trillion annual rate in the third quarter. Okay, so let's just throw another trillion. Let's just sake of discussion, throw another trillion on top of that. So you're at, call it, just for round numbers, 2 trillion, right? 2 trillion, 2.2 trillion. Let's just cut it to 2. Say that, okay, so 2 trillion. So now the Fed's going to sell 95 billion a month in MBS, and MBS and treasuries are fungible. Powell said that in 2020 when he was asked why you buy in mortgage backs. He said, well, it sort of ties into the treasury market. Okay. So let's just straight line that 95 billion a month. Again, let's just cut it at another trillion a year, just to keep the math easy. So another trillion a year in treasury supply, effective treasury supply, on top of the 2 trillion in net supply we already have. All right. So now we're at 3 trillion. And now if the dollar keeps rising, foreigners have to sell FX reserves to defend their currency, which FX reserves are held in treasuries. Okay. So let's just say for conservative numbers, they'll sell another trillion a year. So that's another trillion on top of the 3 trillion. So now you got 4 trillion in effective treasury supply. That's sort of, if the dollar kept rising and if the Fed goes through with QT at the prescribed rate, that you're looking at absorbing. And you say, okay, who's the buyer? Well, with the dollar at 109, it ain't European investors and Japanese investors, because FX hedge yields for both of them were pretty negative. So that probably factored in some of the calculus of let's get the dollar down if that made it to place. Other than that, you're looking at the U.S. private sector. Or basically take money out of risk assets into treasuries in a safe haven. Okay, great. That can work for a while. I think that's what we've been seeing over the last, when we saw the 10-year chart with the yield coming off since mid-June. But that can only work for so long, because ultimately if risk assets move down, then consumption moves down, GDP moves down. As GDP moves down, deficits move, tax receipts move down, deficits move up. Now you have to add to that effective treasury supply number, wash, rinse, repeat. You get yourself into sort of this death spiral. So, long-winded way of saying, look, I think I'm pretty skeptical they're going to be able to keep going with the $95 trillion in QT for very long. And so ultimately, like I started with, I think rates go up as a result of it, or they stop going down. But and ultimately, that's negative for housing.
Yeah, I agree with that assessment of it. And I want to we got 2 more things we're going to talk about. One is Bitcoin. You've talked a lot about this. Let's pull up the chart of Bitcoin. What is your view on Bitcoin right now?
I think Bitcoin is still the last functioning smoke detector that policymakers have been that they've been unable to break or otherwise disarm or disable. It was early, if you remember, in telling us liquidity was being withdrawn in November, December last year. And so it's been interesting to me in line with what we were talking about before. It seems to have maybe found a bottom and peaking up a bit in the aftermath of this mid-July peak in the dollar and downturn in the dollar, where we speculate that maybe there was some sort of agreement, liquidity arrangement to weaken the dollar a bit, just to maintain stability or try to regain some stability and sustainability for the system going into the election. So ultimately, in the short run, I think it probably keeps grinding higher, because I think when you get things like a peak in inflation, when you get a weaker dollar, when you get a desire to make things look as good as possible into an election, I think these are all, you're going to need more liquidity, and I think that's ultimately good for Bitcoin. In the long run, my view of Bitcoin is overly simplistic, but I think it's, for most investors, probably the right one, which is it's a neutral reserve asset with a tie to energy through the proof of work, electricity expenditure of the mining process and the maintenance of the network. And that, to me, I think is a neutral reserve asset that will do very well over time. Neutral reserve assets in sovereign debt crises tend to do very well. They outperform pretty much everything else. in the last global sovereign debt crisis 100 years ago after World War I. Just gold was really the only neutral reserve asset. I would make the argument that gold, Bitcoin, and maybe oil or energy more broadly are effectively neutral reserve assets at this point.
And do you look at Ethereum at all, or is it just not even on your radar?
No, I do. I've traded it a little bit, but I don't get into all of the sort of it really, like I said, I'm sort of I'm not that smart. I'm not that
The
smart guy in
maximalists on
crypto
the
stuff.
Bitcoin versus the Ethereum people is I've gone into some of these spaces and I'm like, man, they just butt heads like nobody's business. That's the one thing it's hard for me with the Bitcoin maximalists is it's just Bitcoin.
Right.
And I say, okay, I own both, but I will say this: I've used ETH so many more times in terms
It's
of
more alpha. I think like you can make the case based again, it's strictly, I'm not making a comment about the protocols or what's better.
exactly.
Strictly, if I was a trader, agnostic, if I said if I knew for 100% the liquidity is coming, the action of the last several years at least would tell you that the more beta way to play it is to buy ETH than to buy Bitcoin. And I think we've seen that, right? Like,
Yeah.
I think since that July 14th date, like that we speculate the dollar was agreed to be weak, and ETH I think is up 70 or 80%.
Yeah, it's up over I think about 1,000 points at this point. You mentioned oil. I mean, we'll take a look at it. We'll go back to the crude oil and then we'll end with stocks. But oh yeah, crude oil. We gotta make that a little bit better here on the chart. Um, let's see, get rid of some of my tools. Okay, yeah, crude oil. It's actually bounced a little bit since we've been on from earlier. But what are your thoughts on crude?
From an intermediate term base, I think energy is a core buy, and the reason I think that is we've done a lot of work on peak cheap energy, which is not to say that we are running out of energy. We're not running out of oil and gas. We are out of cheap oil and gas. We need, in order to replenish depleting reserves, you need a significantly higher price of oil. And so from an intermediate term basis, I continue to really like energy, continue to hold and recommend energy. From a short term perspective, it is so politicized that you can just see it seems like the administration wants oil down until the election, and they are pulling out all the stops. You've seen an unprecedented rate of decline going back 40 plus years in the SPR, the Strategic Petroleum Reserve. They are just dumping oil on the market. I want to be careful about ascribing motive to this, but several oil traders have reached out to me, or oil industry people have reached out to me with this, this EIA report that gasoline demand was down versus 2020 when everyone was staying home last month. And it's a real head scratcher because, the chief marketing officer of Valero, one of the biggest refiners in the country, came out and said, yeah, we're not seeing that. That's in fact, we're up year over year, that we don't know where they're getting that number. And so maybe somebody made a spreadsheet error. If I wanted to put on a little bit, probably not that much of a tinfoil hat, I would say, gosh, having the EIA come out and say that demand was way down would be helpful in achieving a goal of getting, just some of the speculative money out of energy and getting paper sellers to do some of the work for you ahead of the election. That sounds a little crazy. I don't know if it is or it's not. Bottom line is, I think oil probably doesn't go a lot lower from here. It probably doesn't do a lot on the upside between now and the election. I think it is a key prerequisite to a Fed pivot, right? So we've gone from, 120 to 88, 86, wherever we're at today, 90, 91.
91.50. Yeah.
Ultimately, the U.S. has to buy back that oil. They got to cover their short, right, in the SPR. Ultimately, the big four U.S. shale basins are still declining at about a 5% per month in the legacy wells. So you've got to increase production 5% per month on very large installed bases just to stay flat for the foreseeable future. That's going to require higher prices. So, from a trading perspective, I think it's probably, not a whole lot to do. I think it probably just chops here till the election. And then I think as we get close enough to the election that people don't notice that, gas is, back to a four handle or, higher threes before the election, at least here in the Midwest. Then I think you start to kind of get back to, ultimately higher levels and I think probably new highs in 2023.
Yeah, I think it'll have its day again. It's just not right now. I mean, right now everyone's looking at tech stocks again. It's funny how fast things change, and I just want to quickly talk about copper before we talk about the stock market because copper, they call it Dr. Copper because they say that it's, the one that's going to tell you the most about the economy. And look what copper's done, since April, March, April. It's just got completely crushed. It's come back up as of late, as you are starting to see commodities start to firm up again. So it's kind of like, you look at similar to what you're looking at in oil. But what are your thoughts on copper?
It's pretty, I think copper probably can keep moving higher because people aren't going to the copper station to fill up their car. And so the administration, I think these markets have gotten quite political, at least between now and the election. And so I think there will be less effort expended to manage the price of copper than there would be for oil. Ultimately, you've got a lot of the same dynamics for copper that you have for energy in terms of being peak cheap. Again, there's ores out there. They're much more expensive to get to. And then I think too, you in theory have, not in theory, you do have this electric vehicle electrification kick or narrative drive policy imperative, however you want to phrase it, that would all else equal structurally support copper in a way that it might not as directly support oil. I mean, of course, you're going to be using oil and gas powered machines that dig the stuff out of the ground in a lot of cases, in most cases. But I think intermediate term, you just own copper, you just buy it and put it away. And I think you'll be real happy. But short term, it probably bounces a bit more and responds a bit more to what I think is a coming Fed pivot than oil and gas do.
Let's end the day here with the stock market. I know we've touched base on it a little bit. I'm actually going to pull up NASDAQ here. And, let's face it. I mean, you're seeing this market come back in a big way. I think that obviously this is all really stemmed from the Fed, because I don't think the market would be here if the market didn't think that the Fed was getting more dovish. We've really kind of discussed a lot of what your thought process is going forward, but let's talk maybe specifically about tech stocks with NASDAQ and just what you think about them, where they are now, what you see coming from here.
Yeah, I think the whole NASDAQ is as intellectually offensive on some level that it is that, given all of the innovation in a lot of cases that takes place at the companies that make up this index. The index does well, real rates are negative and going to get more negative. And so it really comes down to, do you think the Fed is going to pivot or not? And if they do, then I think we probably go back toward all-time highs in fairly short order. And what is interesting to me, again, is what we talked about at the beginning, is will this happen? I don't know, but what I do know is consensus is heavily positioned for the Fed to be Volcker. They're assigning almost a 0% chance of a Fed pivot at 5 or 6% CPI rather than 2. And history is telling me that the odds of that consensus is assigning it near zero should be closer to 98% or 100% that the Fed's going to have to pivot, whether it's this month or next month or the next month. Like, it's not mid 2023. It's much sooner than that. So that would tell you that this chart should break out above, I don't know, whatever trend line that is. If that's a 200.
It's actually the year to date anchored VWAP.
Oh, interesting. Okay.
Yeah, I keep that up a lot because it's, where are we relative for the year? And, in bull markets, it's extremely helpful because you just grind above it. It's been a while since we've had a bear market. Obviously, not not too long ago with COVID, but that was kind of different. But yeah, so to me, it's just a good marker for where we are with the year.
Gotcha. Okay. Yeah. I mean, for me, I think a key is then what what does the Fed do? And positioning is heavily that the Fed's going to go back to breaking this, that they're going to be Volcker, they're going to put real rates positive, they're going to send the cost of capital higher, and all of these unicorns, and the cost of capital for tech is going to go up, and I think the market is mispricing that risk. I think to oversimplify, I think the Fed's going to run an Argentina playbook. I don't think they have a choice, because look, when you have an Argentina debt position, you have an Argentina fiscal position. The only reason you don't have the market is not discounting an Argentina-like monetary policy is because of American exceptionalism, and I don't know that that's I like I said before, I get really interested in situations where consensus is assigning 0% odds of something, and history is telling me I should be rating those odds way higher.
If there's anything we learn, when everybody thinks that something's going to happen, it doesn't.
Exactly.
This year's a little kind of different with the down move, but why I box this area out is because that's how long it is until the next Fed meeting. And I feel like, to me, when I look at that, I say, man, that's a long time. September 21st, it might be a little longer. It might be somewhere in here or something like that. But still, nonetheless, I think that right now you have the bears, who I think are right in what they're thinking and the reasoning. But you have this time where this market just loves to go up. I've been around long enough to see where it's like, we have to wait now that we've gone through this CPI that was the most important CPI ever, is kind of how we started, to now what is going to be the most important Fed meeting ever. It's going to be interesting to see, because momentum right now is in the Bulls' favor, and we'll see how far they can push them, and kind of what that does change between now and when the Fed does speak. I mean, let's face it, the markets, they could say what they want. A lot could change on all the markets we talked about today over this course of time. It is August, and things can really start to get moving around. As you know, most people really kind of aren't around right now. I know that I'm even. It's right. You do have Jackson Hole. You're right about that. Jackson.
Yeah,
Hole.
That's one thing to watch. I was going to say is that, it's weird, because you've got Jackson Hole before then, which is still, it only splits that chart. I would say not even, it takes about a third off of that chart in the box, right? So it's still a long time from a trader's perspective, especially in illiquid markets. And the other thing too, that a number of people have brought up that I think is a really relevant point is there's a reflexivity to this rally that becomes almost like through the looking glass. What I mean by that is the higher the market goes, the better the economy is going to be, and the more the looser financial conditions will get, and that will make it harder for the Fed to pivot. And so you get into this reflexivity of can the market get too excited and force the Fed into disappointing at the end of August? Very possible.
Yeah. Well, Luke, all I could say is thank you so much, man. I'm a huge fan of yours. I listen to your other podcasts when you're doing them. Like I said to you or before we talked today, one of my favorite podcasts this year was the one with you and Eric Townsend, who's a friend of mine. He does an excellent job. If you guys haven't heard that podcast, I even go back and listen to it. It was very, very good. And just really laying out all this stuff, I really do appreciate it. I highly recommend everybody follows you on Twitter and goes to your YouTube channel and checks out your website as well. So before we go today, everybody, Luke, just tell everybody where they can go to learn more about you.
Absolutely. FFTT-LLC.com is our website, and at Luke Gromen, LukeGromen on Twitter. Pretty active feed, and you can find me there.
Yeah, everybody. And like I say, I mean, you got to go to his YouTube channel too. I think what you do bi-weekly, right?
Bi-weekly. Yep.
Bi-weekly,
You did 10-15 minutes updates.
Yeah, and you do. You're always answering questions. I know a lot of times you'll even start off with just even answering questions from people, and so he's great at that. And look, this is the time as traders, everybody out there, we need people follow people like Luke to learn more about what's really happening. So Luke, like I said, I really appreciate it. Thank you for everybody for tuning in today. Will be recorded. We'll stay here, and it will go to audio next. And that's a wrap for today, everybody. I'll see you next week. See you next time, Luke.
All right. Thanks for having me on, Anthony. It's great talking.
Cheers. Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.